Hi everybody, and welcome back to video number 9 in chapter 20. And when we left off, we were looking at the Thomas Company, the lessee, under the Alpha and Bravo scenarios here. And the solution is, under Alpha, since the term of the lease is not more than 12 months, Thomas is able to elect the short-term lease exception because the lease term is not more than 12 months, as it does not expect to exercise the renewal option. But under Bravo, the expected lease term is greater than 12 months because Thomas does expect to exercise all 3 renewal options. Thus, Thomas is not able to apply the short-term lease exception and must record a right-of-use asset and related lease liability. Okay, presentation in the financial statements. Here, to summarize how the lessee would report information related to finance and operating leases in the financial statements. So for a finance lease, on the balance sheet, we're going to show a right-of-use asset and a lease liability. Same thing for an operating lease, a right-of-use asset and a lease liability. But under the finance lease, on the income statement, we're going to show amortization expense and interest expense. Whereas under the operating lease, we're just going to show a lease expense. Okay, so the summary of how the lessor is going to report the information related to the sales type and operating leases in the financial statements. On the balance sheet, on the sales type lease, lease receivable presented separately from other assets. And we would de-recognize the leased asset. And then for the operating lease, we would continue to recognize assets subject to operating leases as property, plant, and equipment. On the income statement, our interest revenue, sales revenue, and cost of goods sold would be reflected, and the selling profit or loss under a sales type lease. But under an operating lease on the income statement, the revenue generally would be recognized on a straight line basis and depreciation expense on the leased asset. All right, qualitative lease disclosures. Here is an illustration. Lessees and lessors must also provide additional qualitative and quantitative disclosures to help financial statement users assess the amount, timing, and uncertainty of future cash flows. Qualitative disclosures to be provided by both lessees and lessors are summarized here. 1. Nature of its leases, including a general description of those leases. 2. How variable lease payments are determined. 3. The existence and terms and conditions for options to extend or terminate the lease and for residual value guarantees. And lastly, 4, information about significant assumptions and judgments, such as the discount rates. All right, now, quantitative disclosures would include the total lease cost, 1. 2, finance lease cost, segregated between the amortization of the right of use assets and interest on the lease liabilities. 3, operating and short-term lease cost. 4, weighted average, remaining lease term, and weighted average discount rate segregated between finance and operating leases. And 5, maturity analysis of finance and operating lease liabilities on an annual basis for a minimum of each of the next 5 years. The sum of the undiscounted cash flows for all years thereafter. Okay, decision analysis. With the increase in assets and liabilities, a number of financial metrics used to measure the profitability and solvency of companies will change. 1, return on assets will decrease. Number 2, earnings before interest, tax, and depreciation and amortization, EBITDA, which likely will require some adjustments as companies amortize right-of-use assets. And number 3, the debt-to-equity ratio will increase and the interest coverage ratio will decrease. All right, let's change the subject and look at describing the lessee's accounting for sale-leaseback transactions. And here, a sale-leaseback. In a sale-leaseback arrangement, a company, the seller lessee, transfers an asset to another company, the buyer lessor, and then leases that asset back from the buyer lessor. For example, Darden Restaurants sold off its Red Lobster division to Golden Gate Capital, and then leased these restaurants back from Golden Gate Capital. And this little diagram shows that. Here's Darden Restaurants selling its underlying assets here to the seller lessee, and here the buyer lessor. And that Golden Gate Capital then transfers the right of use of the underlying asset to Darden. Okay. Now, why would a company like Darden engage in a sales-leaseback transaction? Well, number 1, Darden can use the cash that otherwise would be tied up in property to expand its operations. At the same time, it continues to use the property through the lease term. Number 2, Darden can structure the lease arrangement so issues such as repurchase provisions, refinancing issues, and conventional financing costs are minimized. And number 3, Darden may receive a tax advantage in that the entire rental payments are tax deductible, whereas under conventional financing, only interest and depreciation can be deducted. So the advantages to the Golden Gate Capital, who is the buyer lessor: 1, it generally can earn a higher rate of return under a sale-leaseback than under traditional financing. And number 2, during the lease term, Golden Gate is protected from a downturn in the real estate market and may have an inflation hedge provided the property appreciates in value. All right, so what are the accounting issues in a sale-leaseback transaction? The accounting issue is whether the transaction is a sale or a financing. 1, if control has passed from the seller to the buyer, then a sale has occurred. If control has not passed from the seller to the buyer, the transaction is recorded as a financing, often referred to as a failed sale. Okay, in a sale, gain or loss recognition is appropriate. Darden then records the transaction as follows. 1, increases cash and reduces the carrying value of the asset to 0, referred to as derecognizing the asset. Number 2, recognizes a gain or loss as appropriate. And number 3, accounts for the leaseback in accordance with the lease accounting guidance used in this chapter. So, if we look at this illustration, has there been a sale of the underlying asset? If yes, then we apply sale-leaseback accounting. If no, we account for the entire transaction as a financing. Okay, let's take a look at an illustration. Here, the Scott paper sells one of its buildings having a carrying value of $580,000. That's the building, $800,000 less accumulated depreciation of $220,000 to General Electric for $623,110. It then leases the building back from General Electric for $50,000 a year for 8 of the building's 15 years of remaining economic life. Assume that the present value of these lease payments is equal to $310,000, such that the lease is classified as an operating lease. So, what are the entries that Scott Paper should make to record the sale leaseback? So, to do that, we're going to debit cash for $623,110. We're going to debit and remove the accumulated depreciation here of $220,000 and debit and remove the buildings for $800,000. And we're going to record a gain on the disposal of the asset of $43,110. And then to record the operating lease from General Electric, we will debit the right of use asset here of $310,000 and credit lease liability of $310,000. So, in a failed sales scenario, a financing transaction, Scott Paper does not record a sale in the above transaction if the lease from General Electric is classified as a finance lease. In a financing or failed sale, Scott 1 does not reduce the carrying value of the building. 2 continues to depreciate the building as if it was the legal owner. And 3 recognizes the sales proceeds from General Electric as a financial liability. So, the entry to record the financing is as follows. We're going to debit cash for $623,110 and credit notes payable for that same amount. Okay, in a sale leaseback example, American Airlines on January 1, 2025 sells a used Boeing 757 having a carrying amount on its books of $30 million to City Capital for $33 million. American immediately leases the aircraft back under the following conditions. 1, the term of the lease is 7 years. The lease agreement is non-cancelable, requiring equal rental payments of $4,881,448 at the end of each year, ordinary annuity basis, beginning December 31, 2025. Number 2, the lease contains no renewal or purchase options. The plane reverts to City Capital at the termination of the lease. Number 3, the aircraft has a fair value of $33 million on January 1, 2025, and an estimated remaining economic life of 10 years. The residual value, which is unguaranteed, at the end of the lease is $13 million. And number 4, the annual payments assure the lessor of an 8% return, which is the same as American's incremental borrowing rate. That looks like a good place for us to stop this video. And when we return, we'll take a look at applying those classification tests to this example. Until that time, bye for now.